Hello and welcome to RCLCO's July Economic Update. I'm Scott Bommarito, our Vice President of Research at RCLCO Fund Advisors, and I'm here to bring you a couple of the most recent economic updates from the last month. Well, of course, we have to start again with the latest inflation report since this continues to dominate headlines. On the positive side, we did see further deceleration in both headline and core CPI. Those fell to 3.5% and 2.6% respectively. So an improvement over the last couple of months, but still well above the Federal Reserve's target rate for inflation. Looking forward, most forecasters and economists continue to expect further moderation in both the headline and the core CPI rates, although that will play out over the next year or so. Most forecasters maintain that at year end 2026, inflation is likely to be north of 3% still. So higher than desired, although moderation over the next year or two. Of course, there's still a high amount of uncertainty in any inflation outlook, given the very dynamic situation during on the ground in the Iran war, with the Strait of Hormuz opening and closing. That's elevated uncertainty with oil prices, which then continue to trickle down through to the rest of the inflation measures. Higher inflation has continued to put upward pressure on interest rates as well. So we've seen a continued development of that same story play out over the last month. Forecasters here continue to forecast about a 4 to 4.5% steady state for the 10-year US Treasury rate. However, over the last several weeks, for most of July, the yield has been north of that at about 4.5 to 4.6%. So again, forecasts here are going to be subject to what happens in the broader geopolitical climate, particularly as that then impacts interest rates from there. So likely that the 10-year will remain higher than current forecasts anticipate. That said, on the shorter term rates, most expectations are that the Federal Reserve will increase rates by 25 basis points once or maybe even twice by the year end. So that is a significant development from the beginning of the year when cuts were more likely. Now futures market pricing implies hikes rather than cuts. Well, leaving behind the world of elevated inflation and higher for longer interest rates, we'll turn to the job market. And rather than rehashing monthly job growth, we wanted this month to look at a different angle, looking at openings, hires, and quits within the job market. So a positive development here, job openings ticked up in the first half of 2026. Openings are up to their highest level since January 2025. So this is indicative of continued growth in the broader economy, which of course is a positive. However, despite the increase in openings, we've seen that hires and quits have remained somewhat down relative to their longer term averages. This continues to suggest that the labor market is in a no hire, no fire equilibrium that has become the norm over the last couple of years. So overall, this paints a picture of stability in the labor market, which has both positive and negative effects. On the positive side, this has kept the unemployment rate low. On the negative side, it has made it more challenging for people entering the labor market to find meaningful employment. Elsewhere in the economy, the ISM Purchasing Managers Indices have delivered positive news over the last couple of months. So throughout 2026, both the manufacturing and the services PMI have read above 50, which indicates that both sectors are in expansion. So again, this is, of course, a positive development for broader economic activity. Looking at the sub-indices within these two broader PMIs, we see that employment is the lowest sub-index in both manufacturing and services. That likely is due to some of the no hire, no fire dynamic that we just touched on in the employment market overall, and that's dragging down the reading somewhat. However, new orders and business activity are both strong and supply chains look healthy. So overall, the picture is positive, with economic activity continuing to move along in this rate of expansion. Finally, looking at retail sales, we get some more positive news as well. Total retail sales have been up 6.7% over the last year, and core retail, which strips out some of the more volatile components, was also up by a very healthy 6.4%. So this is a very strong growth rate, very positive development for the overall health of the US economy as consumer spending has held up, and retail sales here reflect that. So overall, the US economy remains on strong footing despite the near-term risks of elevated inflation and interest rates. That concludes our July update. Please continue to follow along for more webinars and more economic updates.